Chapter 14 is on long-term liabilities, specifically bonds. We have three main topics, which are bonds, issuing procedures for the bonds, then additional long-term notes. We will begin our lesson by discussing basic characteristics of bonds. We learned last chapter that a company can issue stock if they need to raise funds. Projects that need a lot of money often are financed with bonds. Issuing stock is called equity financing because the company is giving up equity or ownership of their company. Issuing bonds is called debt financing. This is because bonds are a form of debt. Essentially, the company is borrowing money and will need to pay that back. Bonds have an interest component. Most bonds require the issuer to make periodic interest payments. These interest payments are usually made semi-annual, which is twice a year. The advantages of bonds are that they do not affect owner control, which happens when issuing stock. The interest on bonds is tax deductible. When issuing stock, companies will sometimes pay out dividends, which we learned last chapter. Dividends are not tax deductible because they are not categorized as expenses. Bond interest, on the other hand, is an expense and will therefore reduce net income and the taxes to be paid on that income. Bonds can increase return on equity. A company that earns a higher return with borrowed funds than it pays in interest on those funds increases its return on equity. This process is also called financial leverage or trading on the equity. Bonds do have their disadvantages, though. Bonds require payment of both periodic interest and par value at maturity. Par value is also known as the face value, and we will cover what that means next. Issuing stock does not require any payments because dividends are paid at the discretion of the owner. Just like bonds can increase return on equity, bonds can also decrease return on equity. A company that earns a lower return with these borrowed funds than it pays in interest on those borrowed funds decreases its return on equity. Now we will discuss issuing procedures and some basic terminology. The board approves the number of bonds authorized, their par value, and the contract interest rate. A bond indenture is the legal contract between the bond issuer and the bondholders. It identifies the obligations and rights of each party. A bondholder may also receive a bond certificate as evidence of the company's debt. The par value of a bond, also known as face value, is paid at a stated future date. This future date is called the maturity date. Therefore, on the maturity date, the issuer will pay the bondholder the par value of the bond. The contract rate is also known as the coupon rate, stated rate, or nominal rate. This is the annual interest rate paid by the issuer of bonds. This amount is applied to the par value. And in this course, interest is paid semi-annually, which is twice a year, every 6 months. Let's practice number 1 on the classwork. Identify the following as either an advantage or a disadvantage of bond financing. The following statements are all true statements, and we need to decide if it's an advantage or a disadvantage. For example, A, bonds do not affect owner control. That's a true statement. Bonds don't affect owner control, stocks do. But is this an advantage or a disadvantage of bonds? We just went over this. This is an advantage of bonds, a disadvantage of stock. B, a company earns a lower return with borrowed funds than it pays in interest. This means a company borrowed money by issuing the bonds, and they're using that money to make more money because that's the purpose of borrowing money. They're earning a lower return, let's say 2%, than they're paying in interest. Maybe they have to pay 5% in interest. Is that an advantage or disadvantage if that's happening? That would be a disadvantage. They want to earn more money than what they're paying out in interest, which is where C comes into play. A company earns a higher return with borrowed funds than it pays in interest, meaning we're borrowing money, we're paying interest, maybe 5%, maybe we're earning 10% on those borrowed funds. What would that be? It's the opposite of B. So in this case, it's an advantage. C, bonds require payment of periodic interest. True statement. But is that an advantage or disadvantage? That would be a disadvantage for the company because now they are required to pay out interest. Even if they don't have the money, they need to pay out the interest. On the other hand, with dividends, they will only pay dividends to shareholders if they have the cash and the net income to do so. Letter E, interest on bonds is tax deductible. Like I said, that's a true statement. It's an advantage or a disadvantage. That would be an advantage of issuing bonds. F, bonds require payment of par value at maturity. Just like borrowing money, you have to pay the money back at the end. That's what this means. Would that be an advantage or disadvantage? Disadvantage, as opposed to issuing stock. When you issue stock, the company is not required to buy that back at any point. But when you issue bonds, you do have to pay the money back at the end. Bonds are securities and can be readily bought and sold. Bonds are usually less risky than stocks. A bond issue is the sale of bonds, usually in denominations of $1,000 or $5,000 or even higher. The market value or market price is shown as a percentage of par value or the face value. It is usually a quoted price. An example is if bonds are issued at 97, it means that they are sold for 97% of the par value. Another example is if bonds are issued at 103, that means that they are sold for 103% of the par value. The bond rate is the interest rate on the bonds. Market rate is the annual rate borrowers are willing to pay and lenders are willing to accept for a particular bond and its risk level. When the contract rate and the market rate are equal, bonds sell at par value, meaning that a $1,000 par value bond will sell for exactly $1,000. When the contract rate is above the market rate, bonds sell at a premium or above par, meaning I can have a $1,000 par value bond that sells for $1,100. When the contract rate is below the market rate, bonds sell at a discount or below par, meaning I can have a $1,000 par value bond that sells for $900. Regardless, if the bonds sell at par, at a premium, or at a discount, the interest rate will stay the same because it's based on the par value. And the amount that bondholder receives at maturity will also be the same regardless of how the bond sells initially. Regardless if the bondholder pays more or less for the bond, they will only get back the par value at maturity. I have some students who ask, why would anyone pay more for a bond if they're not going to get it all back in the end? It is because of the interest. The bondholder is earning interest throughout the life of the bond, and they're willing to pay more because of an attractive interest rate. In the end, the bondholder will actually come out ahead, not behind.